the main reason most people get out of bed every day. Hawkeye is making another social statement. This time it is about investing or making money with money.
Welcome to Hawkeye's Hangout.
Remember, people, that I just read it. I did not write it. Okay, here goes. Financial planning and building generational wealth are essential components of a stable and secure future. By understanding and implementing financial strategies, families can secure their financial well-being for current and future generations. It includes budgeting, saving, investing, and managing debts. It involves obtaining assets that appreciate over time, such as real estate and stocks that will generate cash flow. They're the safer ways to make money with money. Otherwise, you will have to go out and get a job. There is more than one way to make money by investing. Real estate is Hawkeye's favorite investment. So how do you know what is a good investment? Today, Hawkeye wants to share with you how to analyze investment real estate. Here's Hawkeye.
Thank you, Calafia. Okay, back when I was working, it was helping people acquire income-producing real estate. It's called investing. You only buy real estate for one of two reasons: to live in it as your primary residence, or a vacation home sometimes, or you buy real estate just to make money. There's no other reason. You're either going to live there or make money. So we're going to focus on the latter. Disclosure: every real estate transaction is complicated, unique, and comes with risk. This video is for information purposes only. Pay attention to the math formulas. You should seek help and advice from real estate professionals. I had been a realtor since 1994. I created this PowerPoint presentation about 2009. Tax form preparer. I had my own tax business. Most of our subscribers are past clients. Notary public. I also did bookkeeping, accounting, a grip on some other businesses. One of these days I'll tell you about the palm tree farm. Buying real estate can be complex and an influence on your taxes. And if it was easy, everybody would be doing it. Like I said, one of the main reasons of buying real estate other than to live in is to create a cash flow. And also you can enjoy some income tax saving strategies. You make money by paying down your loan, and you also make money when the property appreciates in value. The investing process is, first of all, you got to determine how much cash you got to work with. That's kind of important. There's more than one way to buy real estate, but almost always you need some cash. Get pre-qualified for real estate loans. Check with at least 3 lenders, and you're going to get the best deal possible. Also the best service. The properties in your price range and areas. Hopefully your realtor can set you up on an automated email process where you get notified of new properties as soon as they come on the market via email. Go out and preview the property. You make an offer. Essentially, you create a purchase agreement with price and terms. Present it to the seller. He either accepts, rejects, or counteroffer. After you have offer and acceptance, then you open escrow. During the escrow period, you usually have a standard 17-day due diligence period to determine if the property is actually acceptable. Get maybe a contractor, plumber, electrician, get a psychic, inspect all aspects of the property. Also, if the property already has tenants, you want to read over the rental agreements. Get a title report. Title company does a background check on the property. See if they got any liens that they're not disclosing, how much they owe on the property. Go down to the building department. Go down to the county building or city hall. Make sure, the building permits are in place. If a property's got a swimming pool, make sure it's got a permit for it. Put your funds into escrow. They make a loan commitment. They will their funds into the title company who actually pays off the banks. Shop for insurance. When everything, all a loan's funded and all the paperwork's been done, right before you close escrow, you should do another final walkthrough just to determine that the property is in the condition that it was when you made the offer. Plus if any repairs were supposed to have been made, make sure they were done. Don't close escrow until all that's done. During the due diligence period, you should find out the terms and conditions of the current loan on the property. You may be able to get a better deal than applying for a new loan. Hopefully it's assumable. If it is, you could save money on the interest rate over the long term. The loan may not be current and you would have to make up past payments and fees. But do the math, because you may end up saving lots of money on the long run. The cash flow analysis is you got $3,200 a month coming in for rent. Got to pay taxes, insurance, utilities, maintenance, repairs. Most repairs are due to the tenant misusing or abusing the property. Tenants are usually responsible for paying the cost of repairs. This is why you collect a security deposit. Do not confuse repairs with normal wear and tear of the property. So what you want to do is take, your net income, that's the income after the bills are paid, and divide it by your down payment, and you'll get a rate of return on your investment. And hopefully, this will be a percentage. And my recommendation is, unless you got 7% or better, I wouldn't buy the property. Okay, real estate financing. If you haven't owned any real estate in 2 years, you'll probably qualify for an FHA insured loan for a first-time home buyer, which means you only need 3.5% for a down payment. But you have to promise to, live in the property. The loans are good for up to 4 units. You can also get, duplex, triplex, but I would go for the 4 units. Maximum benefit, maximum profit. Non-owner occupied loans, you need 20% down payment. You can use money from your 401k account. If you have an IRA, Roth IRA, even your employer may be putting money into an account for your retirement, and you can legally draw funds from your retirement account to go towards the property. Okay, we have an example here. This was actually an actual sale in Corona. Anyway, here's a layout of the units. So with all those, you have $3,200 per month income. The sale price was $205,000 for a 4-unit property. Of course, this was back in 2009 after a real estate crash. $7,175 down payment. If it's non-owner occupied, you need $41,000 for a down payment. So the owner occupied terms is your payments at 5.5% interest rate, a little lower than they're charging right now, but payments would be $1,123.23 for your principal and interest. So if you calculate your $3,200 per month, that comes out to $38,400 per year. Calculate a 3% vacancy factor, you still got $37,362 coming in. Expenses, property taxes, $23.58 per year at that time. Property insurance, water bill, probably the most expensive, $28.33, and $2.97 for trash. And you got to have a guy coming by and mowing the lawn once in a while, unless you do it yourself. Here's all your operating expenses, not including repairs or mortgage interest. Taxes, insurance, utilities. You still made $32,369. Your net operating income. For the year, principal and interest payments are $13,479. Subtract that from the net operating income, and you still have a cash flow of $19,153. That's $19,000 in your pocket. So when you do your taxes, you had $32,632, coming in after the vacancy factor. And then you subtract how much interest you had to pay. Subtract depreciation, and depreciation is a great deduction. Here you got $7,069 deduction, and that's not really money out of your pocket. But with that said and done, you had $14,000 in taxable income. But that's after you put that $19,000 plus in your pocket. So it's $4,400 of tax-free money. $4,400 that you got put in your pocket and not paying taxes. So if you take that cash flow and you add the $4,400 and your principal reduction, paying down the loan, appreciation of the property going up in value, that's a projected $32,000 income or profit that you made. It's not actually cash in your pocket, but on a technical sense, that's how much money you made. So the final thing here is you made $32,372 in profit. You paid tax on $14,749. And you did all that with a $7,175 investment. Is that a good deal or not? Thank you for watching our videos. Have an incredible day.
Wow. What do you think about that?
Kevin! I'm going to cash back on the gingerbread house.
Kevin Hart has got it all wrong. This is a lot better way to make money than running up your credit card. In conclusion, financial planning to build wealth is pivotal for ensuring long-term financial stability. It provides a structured approach to managing finances, future uncertainties, and securing a brighter future. By prioritizing this aspect, you can achieve a sustainable and prosperous financial legacy. I am the hostess of Hawkeye's Tales and Trails. Please subscribe. Have a prosperous day.
What's your name? What's your name? Who's your daddy? Who's your daddy? Is he rich like me? Has he taken any time to show you